Good evening, everybody, and welcome to tonight's webinar. My name's James Poyser.
And my name's Nadeem, Head of Tax here at Provestor.
If you don't know Provestor, we're a specialist property accountancy firm, and we basically try and make tax as hassle-free as possible for property investors so you can get on with what you want to do, which is invest in property. And tonight we're going to be answering your questions. This is a live Q&A. Ask your questions and they're going to come up here, and Nadeem's going to answer those questions that come through. Now tonight we're focusing on setting up limited companies to buy-to-let properties. So if you've got a question about it, hop into Zoom, and at the bottom of the screen you'll see a little Q&A icon. Click that, write your question, and that'll pop up on our screen. And also whilst you're in there you can see other people's questions, and if you put a thumbs up next to it, we'll know it's a popular question and we'll try and prioritise answering that question. So what we're going to do, I've got a few questions for Nad just to get us going once you've got your thinking caps on, and for the rest of the webinar we'll then take a look at your questions, and we're here for the next 30 minutes or so. Now to kick us off, I thought what we'd do is put up a little poll. So we're going to put it on the screen now, just to understand a bit more about who's watching tonight. So just three dead quick questions. So if you take a look at your screen, just trying to find out, do you currently own any buy-to-let properties? Are you thinking about buying your next buy-to-let property in a limited company? And what's your horizons? We're really interested to know what the feelings are for landlords at the moment in terms of timescales and when thinking about making their next investment. Whilst you're doing that, I'll ask a little question of Nad to get us started. So Nadeem, quick potted summary, why are so many landlords using limited companies at the moment?
Yeah, great question. And really, the reality of why we are in this situation, James, is because actually limited companies have been around for a very long time, and they've been more and more popular over the last 6-7 years. And some of you may have heard of Section 24. Okay. Mortgage interest restriction rules that came in place sort of from 2016 onwards, and slowly but surely people have sort of realised or seen the impact of what taxes has done in their personal capacity, and as such what that's meant is people have looked at using limited companies, and they've just become very much more accessible to people. So, certain things like finances have become very much easier in limited companies.
Yes, okay.
People have understood how tax efficient they are, not only for the short term, but sort of for family planning purposes.
Yep.
And they're easy accessible. So
what's the key difference then? So buying a personal name impacted by Section 24, that's the legislation that came out a few years ago, and buying through a limited company, what's the key difference there?
So the key difference is that the rules for limited companies are not impacted by Section 24. So if you have personally held properties, the amount of mortgage interest you can deduct from your profits is restricted to the basic rate, so 20% maximum. So you can imagine how that impacts landlords who have a number of properties which are interest only, whereas in limited companies, we're not impacted by those rules whatsoever. So what that does as a result is keeps your profit low and means you pay less tax.
Yeah, great, fantastic. Yep. Right, let's just take a look at this poll. So I'm just going to put the results on screen for everybody. So what we've got, so about half the landlords tonight are already got buy-to-let portfolios. Great, really interesting. 92%, no surprise, we're doing a webinar on limited companies. 92% of you are considering buying through a limited company. And in terms of timescales, great. So 45% in the next 6 months, another 45% in the next 12 months or so. So it sounds like there's a lot of intention there, a lot of commitment in terms of go ahead and buying through a limited company. Okay, so next up, Nad, another quick one for you before we drop into people's questions. What are the top pros and cons when it comes to limited companies?
Yeah, and it's very easy to get lost in the world of Google and try to find why limited companies are great for you. And there's a lot of information out there, and a lot of good information as well, but it's not necessarily the right thing for everybody. So we talked about some of the pros, some of the big pros being tax, and of course that's what's pushed a lot of people into using limited companies for the next purchase, or even moving their existing portfolio into a limited company. And I see we already have a question about that come through, James, so maybe we can talk about that. But that is one of the biggest pros, that from a tax point of view, if you're a high rate earner paying tax at 40%, 45%, limited companies at the moment, 19%, it's a massive saving. And so for those who want to build a portfolio of 1, 2, 5, 10 properties, subject to the amount of profits you make, you can only just pay 19% potentially at the moment, which is considerably less than the 40-45%.
I mean, that probably leads us into our first question actually from Dee. So Dee's asked, is a basic rate taxpayer better off not setting up a limited company as far as tax goes?
So, is this a Section 162, sorry, question?
No, this is as a basic rate taxpayer, are you better off without a limited company?
Yes, absolutely. So yeah, Dee, so this is what the con I said here in terms of the pro and the con about how to look at your affairs about using a limited company. And in reality, some people do overcomplicate their scenario and get into a limited company when they don't necessarily need to. So if you are a basic rate earner and you don't see yourself going past that basic rate band, i.e. 20%, roughly £50,000 in terms of your total profits earnings in the year, then I would say no, a limited company probably isn't going to be tax efficient for you, because you're going to be paying tax at 20% at basic rate D, and you'd be paying 19% in a corporation tax within a limited company, but you'll also have to have a double taxation in terms of you taking money out of a limited company, and therefore another 20%. So you could ultimately be paying roughly 40% by putting the property into a limited company, whereas if you were a basic rate earner, you would just be paying tax at 20%. And this is where it's really important to get advice, because if you just have 1 or 2 properties that are keeping you in that basic rate band, then fine. If your plans are to buy 1, 2, 3, 4, 5, and all of a sudden you very quickly push yourself into that high rate or additional rate tax band, then that's where you really want to get some advice, because it could well be at the moment limited company is not good for you, but maybe for the medium long term, it does become the right avenue for you to take.
So just thought. So when calculating, so your basic rate taxpayer, you're not using a limited company, and you're talking about a growing portfolio. What's the number that's used for tax? Is it the profit from the limited company, or is it the rental income from the limited company?
It's a profit.
It's the profit.
The profit. Yeah. So we're looking at the profit here. So yeah, it's always the profit figure. Yeah.
Okay. Great. Okay. So hopefully, Dee, that's answered your first question. Again, another follow-on, Nadeem. So we're saying, so basic rate taxpayer, potentially not the right thing to do. What's the sweet spot for limited companies? What's the thing where most people are drawn into limited companies that brings them in?
A really common question. And I think when I have a lot of my tax consultations, this is the kind of very common question I get asked, because unfortunately it's not kind of a sweet spot. Everyone's situation is slightly different. From a tax perspective, yes, we'd talk about the £50,000 profit level, income level, because that's what pushes you into becoming a high rate earner. But we always talk about what someone's long-term plans are, because the long-term plans is what draws people towards sort of maybe the estate family planning, the inheritance tax planning, the share structure of a limited company. And it could well be that some people, overseas investors, for example, are still better off using a limited company because they have other issues in the UK which they don't want in their personal name to be involved in. So a limited company and keeping your investments diversified in limited companies the right way. So not really the kind of answer you may be asking for in terms of is there a sweet spot, but I think there is. Everyone's situation is slightly different in that regard.
But I mean, there must ultimately be a draw, because 8 out of 10 buy-to-lets are now purchased through a limited company. So I guess it's limited company broadly advantageous for a lot of people, but then you've then got a bit of choice and a few decisions to make about how you structure a company, set it up, buy a property, who's going to be your directors, shareholders, and those
Absolutely.
kind of things.
And I think the 8 out of 10 is really, really interesting, because actually over the last few years, in terms of, again, one of the pros of using a limited company is lending, finance has become much more accessible, much easier, cheaper, and almost as cheap as buying in your personal name.
Yeah.
Of course, individuals are getting more educated in terms of understanding what it means to be a director of a limited company, what the consequences are in terms of being a shareholder, a director, and all the consequences come in terms of managing a company.
Yeah.
And because of that, people are more comfortable using a limited company, and therefore the 8 out of 10 is not really a surprise.
Yeah.
Yeah.
Great. Thanks, Nad. Okay, so moving on to our next question. This is from Paul. Paul's asked, can I use my pension pot to invest in a limited company that purchases buy-to-let properties?
Yes, Paul. I mean, you can. It's quite a complex area. So we're talking about self-invested pension schemes here. In reality, what you can do is you can actually invest your pension, loan money back from your pension into your limited company and reinvest into commercial properties, which is a very tax efficient way of operating. And a lot of investors do that, and hence why they create these pension schemes to be able to do this. Something to be aware of is always get the pension advice to make sure it's actually right for you, and actually get the right type of investment, self-investment scheme in place. I see a lot of investors who fall foul on the pension scheme that they set up, which doesn't allow them to do that reinvestment model. And of course, you've got to make sure you're getting the right types of properties. So if you're looking at buying residential buy-to-let properties, unfortunately, that won't work. It's got to be commercial properties only, which that pension scheme can reinvest in tax-free.
Yeah. Okay, interesting. Hopefully that's answered your question, Paul. If you've got any follow-up questions, just pop them into the Q&A. Yeah. So another question. This was actually emailed in from us for somebody who can't make it, and they just want to clarify about when you buy property through a limited company, who actually owns it? How does that work?
Yeah. So obviously, a limited company works slightly differently to you being a sole owner of a property. So as an individual, you are a shareholder of a company and you have shares in that entity. And when it comes to the owner of the property belongs to the company and you own the company in the form of shares. So when it comes to things like lending and the banks, they will look at effectively who the shareholders are, because the shareholders are the ones who actually physically own the entity which owns the asset. So in a short response to that question, it's the company that owns the asset.
Yep. Okay.
Yep.
Great. Thanks, Nad. Okay. So another question from D. In fact, Nad, I'll let you choose. There's a couple of questions from D.
Sure. Yeah. Well, D, I mentioned the section 1621 because I saw D, you did ask that question very early on. And can I explain section 162 incorporation leave, how it works? So section 162, I did mention very quickly about how you can move your existing portfolio in your personal name to a limited company, and this is called section 162 relief for capital gains tax purposes. So imagine you're an investor, you have a number of properties in your personal name, it's not very tax efficient for you anymore to have them in your personal name and you want to move them to a limited company. One of the tax reliefs available is section 162 under the CGTA rules, and what that effectively does is removes any capital gains tax that you have on the transfer stroke disposal of that portfolio to a limited company. That has certain caveats to it, and it follows a case called Ramsey versus HMRC. It's quite a complex rule to follow because we're following case law as opposed to tax law here. So we do advise clients on this. It's something which is a case by case kind of checklist. We need to understand whether section 162 applies to your certain scenario. We've also got section 18 of the stamp duty law that we need to look at, and section 15, which is about the stamp duty relief as well. So when you're looking at section 162D, we also want to look at stamp duty relief as well to make sure we can incorporate that portfolio. So again, I can probably talk about this for a good half an hour. In reality, it's something that's possible, D, but get the right advice from the right advisors, because it could well be something you can do. But yeah, be careful on that one.
Yeah, and I think on the incorporation thing, I think we've seen, you may have seen this over the last few months as well. There are a few risky schemes out there, and people are offering to incorporate people's property portfolios for them. Won't go into the details now, but if you're thinking about, if you've got an existing portfolio and you're thinking about how you can incorporate it, drop us an email and we can recommend some really good advisors. It's not something that we do directly, but we know some really reputable people who can help you out and hopefully avoid some of these snake oil salesmen who are out in the market at the moment. So if you think about incorporating an existing portfolio, drop us an email. We're happy to give you a recommendation.
Yeah, and I've just seen Dee's mentioned section 15 of the stamp duty, and that was what I made that point before I saw that, Dee. But yeah, the section 15 is the stamp duty relief when you move an incorporated portfolio from yourself to a partnership and from a partnership to a limited company, and that section 15 is a relief you get for stamp duty purposes when you move it from a partnership to a limited company. So you can see how complex this transaction becomes, because ultimately we need to move it into a partnership to be able to move it into a limited company, and those reliefs you've just mentioned there are the capital gains and stamp duty reliefs that you can use to not pay anything on incorporation.
Yeah, and hopefully that's answered Paul's question. So Paul, you asked, can you explain stamp duty relief again, please?
Yes,
that's what we just covered.
Exactly. Yeah. So if that's what if you're talking about stamp duty relief on incorporation, then hopefully I've covered that for you, Paul, in terms of that section 15, which Dee also asked as well.
Yeah, and if not, just drop it in again, Paul. Great. Okay.
So we've got a question up from. So we scroll down. Sorry.
Yeah.
The other way. So. About David from David Irwin.
Yeah, David, why would I not just set up a 20 quid limited company in 5 minutes and use something like companiesmadesimple.com? Yeah, you can do it with Companies House directly. I think it's 12, 13 quid. So absolutely, it's something you can do. Do you want to take this, or shall I take it? Or
yeah, I mean, I can, because we know a lot of our, when we talk about our tax consultations, our advisory, and why it's important to speak to a tax professional in this regard is because you're absolutely right. You can make a company for £12, £20. It's a little bit more complex because when you're setting up a limited company, you've got a number of things to consider, not just who the director and who the shareholder is going to be, but actually from a long-term perspective, is the company fit for purpose in terms of what your plans are going forward? And that could mean a multiple amount of things in terms of considering at the point of incorporation. So do you want one shareholder, two shareholders, five shareholders? Is it children, grandchildren? What types of shares? How many shares? Is that going to be fit for purpose from a lending point of view? Over the last 2 or 3 years with COVID, we've seen how should we put it, how up and down the lenders have been and the banks have been with regards to company structures. And we still know there's some high street lenders who'll only lend to, for example, 2 shareholders in a limited company. Whereas now we are setting some very complex structures up for clients who want children, grandchildren, and even children who are not even born yet, because they want to pass over this portfolio to their children. Now, when you do set up a company like that and you require multiple share classes or shareholdings and giving different rights to different share classes, that's where this can become quite complex, David, if I'm honest, because you probably want to understand what you're trying to do, how many shares you're giving to family members, i.e. children, minors, and what that means for you from a lending point of view, because we can set up a company very, very tax efficient for you. But if it means you can't get a mortgage next week because we've set the company up so complex, then actually it's not fit for purpose. So you really need to understand what your plans are from a long-term point of view and make sure it's commercially viable. So getting a little bit of advice is probably worth it. What you don't want to do is set up a company for £20, try to get a mortgage next week and you get stuck. Or you buy a property and then you realise you're too late because you set the company up in a way which you shouldn't have, and then you're trying to unpick things, and that could be quite costly from a tax perspective.
And even so, so Nadeem's point is focusing on the tax advice side of this, which is think about your end goal, think about what you want to achieve, think about the tax structure to make that happen, how that translates into the structure of your company, and then work backwards. And then if you're talking about a complex incorporation, then it's helpful to have a firm like Provestor help out with that. But even if it's a slightly more trivial incorporation, so let's consider you're going to invest with a spouse. So it's two people investing in a company, and you're going to be shareholders. When you set up a company via Companies Made Simple or directly with Companies House, the Articles of Association don't support things like alphabet shares, a really trivial measure for operating tax efficiently. So you can have A shares, your partner can have B shares, you can vary your dividends, and that allows you to be, it's a more tax advantageous way of setting up your company. And the challenge is a 20 quid company from Companies Made Simple or 12 quid one from Companies House doesn't support that out the box. You've got to basically supply your own legal documents. And that's the challenge. So if you're a solo investor with very straightforward investment aims, fine. Anything more than that, you'll quickly become unstuck. Good news is, I'm not going to go into a big heavy sales pitch right now. If you want tax advice, we can do it. It's 249 quid, 45-minute call with somebody like Nadeem to unknot that part. But even using something like Provestor to set up a company is probably cheaper than you think. We charge £89 to set up a limited company, which includes alphabet shares for partners. And we're just about to start a winter sale, and that's going to be £44.50 through to the end of the year. So it's not mega money. So if you're going to spend 20 quid with Companies Made Simple, spend £44.50 with Provestor, and we'll get all your documents right for you. There we go. Right.
Yeah, and I think just as a final point to that point, because we do a lot of work for joint venture investors, so people who are not potentially connected to each other, so two business partners. So having things like the right model articles, your potential shareholder agreement, these types of things are really important to get right at the outset, because we see many a relationship that doesn't go how the investors want it to do, and then again trying to unwind these things using the model articles can be very tricky and expensive. So getting these kind of legal documents, shareholder agreements, model articles right at the point of incorporation is really key.
Yeah, and I think there's a great question here actually that's relevant from Heather. If the company is set up and loans achieved, I presume that you can then add shareholders.
Yes, you can. Yeah. So I'm not sure what she means by loans achieved. I presume that's directed.
Well, I guess so. Well, if you're talking about mortgage, I'm going to guess, Heather, you might be talking about a mortgage.
Yes.
When's the point when it becomes problematic to add a shareholder now?
Yeah. So I mean, again, you can, Heather. You're right. One of the things you will know, you will find out though, is that one of the terms in your mortgage is that if you do make any variations to your company, you have a right to notify the lender. So, there are going to be terms in the mortgages where any variations to that company, whether it be director, shareholders, adding, removing, you have an obligation to tell them. Yes, once you've got the loan, once you're making your payments monthly back, the chances are, the lenders are going to be happy, but it could cause you issues if you start doing things to the company which the lenders aren't aware of. And if you do tell them, that could also cause issues. So it's not something we'd recommend you to do.
And what about the tax implications as well?
So tax implications as well, yeah. So if you are adding shareholders to a business, you are effectively, depending on who you're giving it to, so there are spousal exemptions for tax purposes if you're giving shares to your husband or wife. But if you add your brother or your sister or your children, effectively you are transferring some shares. If you are transferring the shares from them to them, to yourself to them, that effectively may trigger a capital gains tax charge as well as stamp duty charge as well, depending on if you are charging them for that consideration transfer. So things to consider commercially and from a tax perspective as well.
Yeah, great. Thanks, Nad. I was going to pull up Sarah's question here. So quite specific and a really common scenario. So Sarah's asked, sorry if it's Sarah. What's the best way to set up in regards to shares and shareholders? Me and my fiance are looking to set up with the aim of buying a portfolio of properties with the aim of supporting our children later on in life.
Yeah, and this is a classic example, Sarah, of you having one eye in the future, which is right, but also making sure you want to get your company set up correctly for you today. So depending on the level of equity and debt you're going to be getting into this business, we want to make sure the company's fit for purpose now so you can actually start buying these properties. But also we want to keep an eye on what you want to do in the future, which is obviously give the portfolio or shares in the business to your children in the future. And there are a number of ways you can do that. You could potentially give them a very small percentage of the business from day one, subject to your lender being happy with that. So minors under the age of 18. What you could do is you could put something called growth shares in place, which allows you to effectively keep the majority of the company today, but actually only allowing your children's share classes, so your alphabet shares, your children's class of share, to have growth. And what that does is it allows you to still keep control in terms of voting rights and the percentage in terms of the actual business ownership outright in your name and your husband's name, the adults, but it allows a growth, which is what, from an inheritance tax point of view, you want to give away to your children, because you don't want that inheritance tax exposure on your estate to your children straight away. So it kind of gets two things done in one. It allows you to keep control, allows you to have the majority of the business, allows you to have the children in from day one, but it gives them very little control and very little ownership, but the growth with them. So there's that you could do. You could actually implement something called growth freezer share, where you can do that sort of in the future. So yeah, lots of different options, but absolutely right to be thinking about those things now, because it could be quite costly if 5 years down that line you were having this conversation and saying, oh, what if I was to introduce my two children into the company now, and the company's already worth £500,000, for example.
And it's really, so that the scenario about investing with children in mind is a really common one that we hear a lot. So it's things that pop up often are things like, so if you've got young children, thinking ahead to not the long term, not talking about, ultimately when we've popped our clogs and away we go. We're talking about things like university fees. So so building a nest egg to pay for your kids' university fees, or for them to get a deposit on their first house. So there's these goals that come up again and again with people who are investing in property. And I guess the point is that, right, you've got this eye on the future, fantastic, and that's a great point to take a little bit of advice and just understand, right, the best way of getting there. Talk through what you want to do and get the structure that's right for you. Great, hope that's answered your question, Sarah. Okie dokes, right. Okay, where should we go now? Steve, right, okay, the other end of the spectrum. So similar kind of thing, but on a grander scale. Steve, can I set up a family investment company, and is this the best in the mid to long term?
Yeah, so Steve, I mean, family investment company, I'm imagining you're thinking about smart structure, which involves your family members and how that's best put in the mid to long term. I mean, this is a personal response in terms of whether that's best for you in terms of mid to long term, and it really would come down to actually what you're trying to achieve in terms of your portfolio growth. Because is this something you're just doing as a bit of a side hustle? Is it doing something you're doing because actually it's all about passing over to your next generations? In both cases, I normally would suggest always having an eye on family investments, because that's all, those assets have got to go somewhere at some point. So if it can achieve your short-term goals, which is maybe getting dividends out of the business, earning a little bit of side income, but at the same time you've got one eye in terms of your family, and that could be siblings, children, grandchildren, and if you can do it, which you can in a smart way, then why not? And again, this all comes down to personal kind of goals in terms of what people want to do in terms of, and if Steve is already thinking about family, then actually it may well be worth doing that at the outset.
Yeah, and I think that the family investment thing, we take a look at what's happening with companies being set up in the different structures. There's a bit of a breakthrough trend at the moment with a number of people who are setting up limited companies as family units. So this is siblings who are co-investing. And I guess the thing with the property prices as they are, it's the barrier to investing in properties. People gathering their resources and coming together, forming a limited company and investing. So I'd say it's pretty much a breakthrough trend that we've seen over the last 2 to 3 years, is limited companies that have been set up by siblings. Yeah. Great. Okay. Just going to look back. So Pierre, just going to look back to one just to clarify on questions. We're going to, on pensions. So we're going to jump back to pensions. Pierre, sorry to ask, but did you suggest a SIP could loan a limited company a loan to purchase a residential property, or did you say commercial only?
So a SIP or a SAS, self-investment pension scheme, or self-administered pension scheme, can loan money back to your business, your trading activity business, which your pension provider should be able to justify your activity to be a trading activity. What it can do with that money is effectively, it can do whatever it wants with that company, so long it pays the loan back. But to get tax relief, is what you do is you buy a commercial property, because by buying a commercial property, that falls within the rules of your SIP pension, which means that actually the income that commercial property earns can fall within the pension scheme and it'll be tax-free. If you buy residential, it falls foul of your reinvestments. So again, this is where getting that pension advice is really important, because a lot of people think that they can invest in all sorts of different types of properties, but it's not, it's commercial only. So if you want that income to be tax-free in your pension scheme, it's got to be commercial rental income, not residential. Hope that helps.
Thanks, Nad. Okay, so we've got a few minutes left. So we've just got 5 minutes left now. A few more questions here to answer. If you've got anything else you want to get in, get it in quickly, because we've got five more minutes left of this man's brain. Okay, so Heather, you've got a couple here that are related. So Heather's got a buy-to-let on a personal basis. Can I therefore use Section 612 to avoid CGT and avoid stamp duty? And similarly, if I transfer my own property to a limited company and have one other shareholder, can I benefit from Section 612?
So so Heather, when we discussed here about Section 162, one of the underpinning criteria of Section 162 is that you are transferring a business. Because if you look at the specific rules within Section 162, is that you're transferring a business in one capacity to another capacity and getting the certain tax and stamp duty reliefs respectively. And that's normally done via a partnership route, because a partnership is seen as a business entity in its own right. If you own this in your personal capacity, the likelihood is that you won't be able to justify that it's a business in its own right, because it's going to be seen as passive investment income and not seen as a business. And again, one of the criteria of Section 162 is that you are moving a business in one capacity, i.e. your personal name, to another capacity, to a limited company. And these are the kind of things that we need to go through. So the Ramsey case, we discussed the Ramsey versus HMRC. Feel free to Google that. There's lots of stuff online about it. You'll see some of the criteria that case met to be able to go through the second tier tribunal with HMRC, of which people kind of follow and use as a guidance. It's not a clear black and white checklist as such, but it's guidance in terms of what's gone through and what HMRC accepted. So the fact that it's personally owned, that could be a problem for you in terms of Section 162.
Okay, great. Okay, so last couple then. Quick one, Steve. Hi guys, Steve again. How much do you charge to set up a family investment company for myself, my partner and 2 sons? Thanks. Probably a lot less than you think. What we'll do is we'll send you a follow-on email for that, and that's absolutely the kind of thing that we can have a chat through and support you with. Amit, it's really, good question, Amit. So Amit, I have an IT company where I have some cash accumulated. I can loan these funds to the property limited company without HMRC getting concerned. I'm not sure it's been answered already. Right, okay, great. So Amit, you're an IT contractor, you've had a good few years, you've got some cash accumulated in your business, and you would like to invest in property through a limited company. Really common. So we have a lot of IT contractors on our books, but I'll let the man who's the tax expert answer.
Yeah, so again, very common question, not just from IT consultants, but from other, people who have other businesses and surplus cash lying around. And this is, again, where advice is really important, because one thing we could do here is maybe get your structure a little bit more formalized with maybe like a holding company. And the reason I suggest that is because what we want to do is we want to connect all these businesses that you've got operating, so your IT consultancy, maybe this property company or another venture, because the sooner we can get them in a group structure, the sooner we can actually transfer funds around. You could do a loan-to-loan, a company-to-company loan, even though they're unconnected business as such, even though they are owned by you. It's just making sure you're tightening your belts in terms of loan agreements, making sure you are, having commerciality to these loan, and obviously they pay back. So in conclusion, yes. How the best way is for you to do that, maybe just have an idea in terms of what the long-term plans are, because if it's wiping your IT consultancy company off in the next few years, we can talk about other things that may make that more tax efficient in terms of using entrepreneurs relief or business asset trade relief. So what we don't want to do is pigeonhole you into a group structure if you're going to wind down your IT consultancy in the next couple of years. So again, let's have a chat. Let's see what your plans are, short term, long term, and then get you into a structure which is going to work out well for your long term property investment plans.
Great stuff. I'm going to stitch you up now. So can you, in 30 seconds, give us your brief thoughts on business asset disposal relief?
So business asset disposal relief will not apply for property investment companies, because that's seen as an investment business as opposed to a trade. As I just mentioned with Amit's company, an IT consultancy business, that's a trade and therefore is eligible to business asset disposal relief. So property companies, unfortunately, are not eligible for it.
There you go, you can do it.
I can do it.
I feel like we've just turned up the gas and we're speaking about 200 words a minute, because I can see the clock ticking down. I think we've all got dogs to walk, kids to feed, football matches to go to. Who knows? So yes, that's it. That's it for this evening. I hope you found that helpful. We've really managed to rattle through some really good questions this evening. So thank you for joining us. We've mentioned a couple of things about Provestor services that might be helpful. So if you're thinking about setting up a company, we've got an offer starting soon where it's £44.50 to set up a buy-to-let which supports AB shares for up to 2 shareholders, so ideal for partners who are co-investing. Tax consultation, so Nad's given a lot of answers. If you want some one-to-one advice, hop onto the Provestor website. It's £249 for a 45-minute call with Nad's team. A lot of fact-finding happens, really high-impact call. You'll get a lot of questions answered in 45 minutes, so that service is out there as well. I think that's probably the main things I think that we've discussed today in terms of how we can help you. But as ever, I think Jess has been in touch with you. If you have any questions, feel free to get in touch with Jess, and she'll get it to the right person, and we'll do what we can to support you. So that's everything from us. I hope you've enjoyed it, and yeah, hopefully we'll chat to you soon. Thanks a lot, and good night.